Good evening. Good evening. Can you all hear me, please?
Good evening, sir.
Okay.
Yes, sir.
I'm high, loud, and clear.
Yes, sir.
Okay. So I want us to be able to finish the part of this section because this week is an introduction week. So as for next week, I know it's not majority of us that will follow the train, but there are some requirements needed for us to know who we are going to carry along because I need, if not few, I just need few people to join me so that we can lock in together for 2025 and start this trading journey together. And while we are learning, obviously we will be earning. But the thing is that it's not everybody that will follow this ship we want to say. So that's just the bitter truth. And for this forex, we will be so what would I how would I put it? There are some requirements that will let us know people who are really interested. And is the purpose of that is that we don't just want to be wasting the effort of, you know, just for teaching purpose and taking people along without them realizing or knowing the value of what they are getting. So as time goes on, we'll be revealing all those requirements for us. Now we have the first part of the section of the webinar. We've looked at a lot. If you check the first part of the webinar, we've done introduction to forex, what forex is, where we can trade forex, who are the participants in the forex market, the commercial banks, the central banks, individual or retail investors, and we also talked about why we trade forex market. Yes, there's no commission, no transaction cost. All these are what we've discussed. But if you are just joining us for the first time, I believe you have watched the first part of the section. We dropped the link to the group, so it's on YouTube. So now we want to enter the second part, which will see us come to the end of the introduction of forex today. The second part is, now we want to continue terminologies in forex. There are some slangs whereby even though you tell someone that you trade the forex market, these are the normal things that they expected you to know. It's just like the bare minimum of things to know. Now if you say the first one here, market is bullish. When we say market is bullish, it means market that is going to the upward direction. And if we say market is in bulls, it still means market that is going into upward direction. If we say the market is on an uptrend, it simply means that this market is going to the upward direction. So I can say the market is bullish, I can say the market is in bulls, I can also say the market was on an uptrend. What do I still mean? All I meant is that this market is going to the upward direction. If we go on our chart now, we will see this is an illustration of a bullish market. Okay. Now, if we look at this chart now, this is an illustration of a bullish market. You can see this market now, it is obvious that this market is what? Is bullish, is in bulls. It shows that the demand for this particular market, people are just interested to keep buying. So it shows that this market is on an uptrend. Now, before this market goes all the way here, I will say the market is bullish. It is in bulls or it is on an uptrend. What do I still mean? What I meant is that this market is going to the upward direction, and it shows that people who wants to trade this market, they are always looking to what? To buy. If we say the market is bearish, bearish simply means this market is going to the downward direction. This market is in bearish, this market is in bears, this market is in downtrend. It shows that what this one is going up, while this one is going down. A market that is going up signifies bullish. A market that is going down signifies bearish. It shows that people are selling. Now, example of a bearish market, if we are to look forward to what this market is doing now, you can see that this market has bought for a long time. It was in bullish form, but now what does it look like it is doing? It wants to start what? Selling. That means the market is now looking to be in a bearish market. The market was in bullish market before. Now people have bought all the way here, and what are people doing now? What they are doing now is they are looking to what? They've started selling this market. So it shows, what this simply means is that wherever this market is going to, currently it is bearish. That means in this kind of market, if I'm to make a decision now, I'll be looking to sell, not buying. I will have been looking to buy here when this market was still bullish, but now the market has shown to be in bearish. What will I be looking to do? I will be looking to sell, because the market is now in downtrend. It is now bearish. Now let's continue. The next one here is long. Long is another form of buy. I can tell you, long so asset. What I mean is that you should buy that particular asset. If I tell you to short so asset, what I still mean is that sell. So the word long here is simply means buy in forex market. If they say short, what they simply mean is sell. That means in a bullish market, we are what? We are buying. In a bearish market, we are selling. You long in a bullish market, you short in a bearish market. Let's continue. So leverage. The next one is leverage. What do I call leverage? Leverage is loans. These are the money whereby either the exchange or broker is willing to loan you in order for you to appear as someone that has money, just for you to open a good trade in to be on the proper side of the market. Margin is the next one. You see this margin is my own personal money in my broker or my exchange. The margin is your own money. Any money that requires, maybe the broker is lending you or the exchange is giving you, is loan. The loan here will be added to your additional position, but this loan is not your money. Your own money is either the $100, the $1,000. So that is what we call margin. Margin is your own money that is in your own account. Now the next one here is liquidity. We talked about liquidity. We say liquidity is money. In forex market, what moves this market you are seeing? What moves this market is liquidity. I can't say money. Sometimes I can say money, but in forex terms, we say, oh, there is a lot of volume. Sometimes I can say volume. Volume signifies liquidity. If there is no volume in this market, we won't be seeing the demand. We won't be seeing people looking to buy this market. If there is no money in this market, people that bought to this point, they are now looking to sell. They bought to this point, they've sold, they are now looking to sell. And let me tell you, there are not some people whereby they are buying, and there are not some people whereby they are selling. It is buyers that turn to sellers. Let me show you a pictorial example. If 100 people bought here, they bought, and this market goes to the upside. Now, the 100 people that bought from here, and this market reached here, do you think, even if the 100 people are not selling, at least 50 of them will sell? You see that 50 of them that sold when this market, because when they sell here, they are now looking to take profit, because they bought here and the market has reached here. They are looking to what? To take profit. They are out. And we know that what moves the market is liquidity. It shows that the 100 people that bought here, that took the market all the way here, 50 of them have sold. It will obviously react in the market, and it will make the market fall. Once market fall again, people again will be interested. If they are interested to buy, they will buy again. To what? In order to push this market again to the upward direction. That's literally how you see this market moving. People that bought from here, from this region here, they bought this market to this upside. When this market reached here, we saw some sellers, they sold, they took profit. Some people see it as opportunity to buy again, and this market again went up. A lot of people, they went again, what did they do? They sold. When they sold, some still see the opportunity to buy, and they keep pushing the market up. In a nutshell, this simply means that what keep pushing this market is demand. The demand to buy something, the need to keep buying something. Whenever people see the opportunity to buy, what do? They buy. Until when this market now reached here, the buyers got exhausted. And when they are exhausted, it now shows that this market is now selling. So that means that people that have been buying now, they are selling already. But when the market reached this point, they have started selling. It shows that people are no more interested to buy. What they are interested to do now is selling. You can see. So this is literally how the market evolves in an introduction. So in what moves the market is liquidity. It is because of the money that is inside this market. That's why we are seeing it going up, going down. If there is no volume, if there is no buyers or sellers, the market won't evolve. So it's the money of the buyers and sellers that makes the market be a tradable market, and that makes it have a lot of liquidity in it. So let's continue. The next one now is what we call pips, or unit of measurement. You see pips, in forex market, pips is the unit of measurement at which price moves to the upside or downside. Let's use USD NGN as an example. USD NGN as an example. You see this USD NGN, I can say the rate at yesterday might be 1,500. Today's rate is 1,450. You know, if I ask you, what's the difference between today's rate and yesterday's rate? You say, the market has fallen by 50 naira. It has fallen by 50 naira. That's what you tell me. But in forex, we don't say any currency. We don't say it has fallen by $50 or 50 naira or 50 euro. What we say is that the difference between yesterday and today's price is that it has fallen by what? 50 pips. It has fallen by 50 pips. You can see. So pips is the unit of measurement at which market goes up or it goes down. If the difference between yesterday and today's price is 100, what will I say? I will say it has fallen by 100 pips. You can see. So in forex, we don't say any, regardless of any currency, to make the difference. It is pips we make use of in order for us to know the differences in price. Now let's move forward. So the next one here is what we call bid or ask price. You see this bid or ask price, the broker we talked about earlier on in this section, the broker will let us know that this broker are those that will provide us the market to trade. You see, this market will not give you the exact price. This market will give you its own price, different from the normal market price. For example, if you are bidding, that means you want to buy. The buy asset you want to buy, the broker will not give you that exact rate to open the trade. There might be like an increment. You can see this is the normal market rate, but broker's own might be like this one, might be 622. You can see the last three decimal digits are different. So these differences is what we call spread. You see, this spread is just like a commission fee the broker will charge you. At the end of the day, everybody wants to make profit. So for you to open a trade to buy this asset that has this particular price different from the normal market price, this is how the broker makes their own profit. Euro USD, this is the rate of Euro USD. That means that for you to have 1 euro, you need $1.5 and some decimals at the back. So but if you are to open buy on this particular market, the market will not give you this exact price. There will be an increment. This increment might be like, the difference might be like 10 pips or 5 pips difference. That difference is how the market profits. So that shows that if you are to open a buy position on this market, you won't open it in this market rate, you will open it in with this increment rate. So for a bid price, this is how the broker also profits, and that's what we call spread. That spread is just like the slight difference between the normal market price and the price the broker is giving you. It's just a minimal difference, but that minimal difference is what we call spread. So the spread is how the broker also profits. Now let's continue. Am I making sense? Are we going along? Am I carrying everyone along? Is it clear?
Yes, sir.
Okay, thank you. Now the next one here is stop loss. The next one here is stop loss. You see this stop loss and take profit all together. They are like things that will protect our account. What do we even call stop loss? I have $100 in my account. I want to trade $100. Before I go to that, there's something we call 1:2, 1:3, and so on and so forth, 1:4, and so on and so forth. You see this one? This one represents how much I'm risking times how much I want to profit. At least if you are risking 1, you want to profit 2. That one simply means that with this my $100 now, I want to enter a buy trade from here on Euro USD. I want to buy it Euro USD. Before I buy this asset, with this my balance, which is $100, I want to know that I just want to risk 10% of my initial capital. And if I'm risking 10%, obviously I want to risk just $10 of my capital. If I'm looking to risk $10, I want to make at least times 2 or times 3. That means that if I'm buying here, my stop loss will be below here. My stop loss will be below here. Where I put my stop loss will equivalent to the amount of dollar I will lose if this market does not go in my direction. Now I'm risking $10. I want to buy this market. If it reaches here, I want to make 1:3. 1:3 simply means I want to risk 1. My 1 here is my $10 to make 3. And if I'm risking $10, how much will I be looking to profit with 1:3? If I'm risking $10, how much will I be looking to profit with 1:3? Just for my explanation.
That's $30.
Exactly. That means if I'm risking $10 here, once market reach this place here, when I buy this market and market reaches this place here, I will be making $30. And that $30 is what I now call my what? Take profit. The stop loss I'm trying to make to risk is what we now call, is what my stop loss is. This my stop loss will be here. So that means if I want to buy this asset, I don't expect this market to go down again because I've done my analysis. I expect this market to buy. But if my analysis tends to be wrong and the market goes in opposite direction, I will only be losing $10 and my balance will be $90. A lot of people, the reason why they normally think that probably the forex is this, forex is that, they don't apply what we call risk management. And risk management is there for us to protect our account. If I bag these take profits now, my balance will now turn to what? $130. So that simply means that if I want to take another trade, I still want to be risking my 10. If I want to take another trade again from this $130, I still want to risk 10. If I risk 10 again and I bag 1:2, 1:2 simply means that if I bag this 1:2 and market hits my take profit, my $130 is now $150. So that's how you grow your account. Even if you are to make 2 losses in a row, and you lost, if you are making the 2 losses in a row and you are risking $10, at the end of the day you are still in profit. You will still be left with 130. This is how you grow your account in the long run. So that's what stop loss and take profits are. The stop loss are there to protect our account. In order, if we by any chance maybe the market with the analysis we do did not go well, so the stop loss is there to protect our account. And whenever we are risking 1, we are risking 10 to profit times 3. We are risking 1 to make times 2, to make times 3 or times 4. But there's, for our account to be healthy, it is good to always make 1:2. That means if we are risking 1, you want to make times 2 of what you are risking. That's the healthy way to grow an account. Let's continue. Now, the next one there is what we call lot size. Is what we call lot size. You see this lot size, it is very, very important we know how lot size works. This lot size is what will determine the amount of money you want to risk. Is what will determine regardless of your account size. Now let's look at it. $100. This person has $100. This person has $1,000. Why this person has $10,000? $10,000. They intend to buy a particular asset here. Now, you see this stop loss, lot size. We have 3 types of lot size. We have the standard lot. The X represents standard lot. We have micro. The M will represent micro lots. And we have mini lots. There is an extensive topic on particular, but the purpose of what we are doing is just an introduction. You see, with a standard lot size, if market moves by a pip, we already tell us what pip is. Pip is the unit of measurement at which price goes up or down. If market moves by a pip, you will make $10. This micro lot, if market move by a pip, you will make $1. This mini lot, if market move by a pip, you will make 0.1 cents. So for standard lot, it is 1. For mini lot, it is 0.1. For micro lot, it is 0.01. So that means that when you start trading, you want to open this lot size will determine the amount you will make regardless of your account. Now, a $100 person takes a trade, is looking to profit target 1:3. This person here wants to risk $10. This person here wants to risk $100. This person here wants to risk $1,000. Now, for this person that has $100, this person might be limited to a lot size of micro lots. This person with $1,000 might be limited to a lot size of mini lots. And why this person with $10,000 will be limited to this standard lot, which is 1, 0.1, or 0.01. What I want to derive from here is that they both want to enter the same trade. If this person bags 1:3, it is obvious that with this lot size, the person will be making $30. If this person that is risking $100 enters the trade, God, when is falling here. If this person that is risking $100 wants to trade, if market backs, if it reaches the same point, this person will make how much? This person is making how much?
$300.
$300. Thank you. You can see. Same trade though. But what differentiates between the person with higher account or lower account is this lot size. So with this lot size, and this person that is this person that has $10,000 account, if this person also takes the same trade, risking 1,000, they will be making a whooping $3,000. Now, someone that has $100 that risked 10, that profited 3, that profited $30, with someone that took the same trade, risked 1,000 and profited 3,000, someone that risked $100 profited $300. You can see this is what distinguishes between traders. This is what differentiates traders. My account size might be different from yours. We might take the same trade. You might make more profit than me because you have bigger accounts. But what a lot of people are trying to do is that, you see this person that has $100, greed will set in. Whenever in the next trade, this person will not use a small lot size again. The person will want to use a lot size this person that has $10,000 account wants to use, which is the standard lot. Meanwhile, for this person that has $100, once you use this standard lot, you market only need 10 pips against you. Market only needs what? 10 pips against you for your $100 to vanish. And for you to also open this lot size on $100 account, that means that obviously your broker will have given you a leverage to appear as someone that has big money. But if the market goes 10 pips against you, your $100 is gone. That is why it is always advisable we are ought to use the lot size that tally with our account size. At the end of the day, you don't need to rush. You also want to build your own account steadily. Now, if you are to build your own account to $1,000 now, you can also increase your risk to profit more. But a lot of people, because of greed, because of seeing what others are doing, they forgot that those others that are taking bigger risk, they have bigger account size to take drawdowns. So lot size is what will differentiate how we make money regardless of our what? Of our account balance. So that's what lot size is. So the next one here is what we call swap. So the next one here is what we call swap. You see this swap? This swap is also like a commission the broker will charge us. But this one, the broker won't charge you unless you leave your trade running till the next day. And the charges are minimal. They are always in cents. So it is a minimal thing. Now, the next one here is base or quote. You see this base or quote, it is very important. This base simply means that if I'm to say USD NGN, for example, USD NGN, this USD here is the base, while this NGN here is the quote. That means if they tell us to buy this asset, what they simply mean is that this USD is stronger than this NGN. If they tell us to sell, what they simply mean is that this USD is very weak and this NGN is stronger. So if they say we should buy this asset, they expect this market to be going up, and it is going up like this, it shows USD is strong. And if they tell us to sell, if it is bearish and it is going to the downside, it shows this USD is weak and NGN is strong. That's why the market is what? Going down. So regardless of how we see this pair, one has to be base and the other has to be quote. So that now makes us enter what we want to enter now. Let's move forward. That now makes us want to enter what we call currency pairing. For us to trade, we have to pair a currency together. You can see, just like my explanation, we have to have a base currency and we have to have a quote currency. The base currency always has to be the first one, and the quote currency or counter currency has to be the second one. So it is with this currency pair we ought to make a decision whether to buy or sell. If I buy, that means the first base currency is strong. If I'm selling, it shows the second currency is weak. And if I'm buying, I expect this market to be going up. If I'm selling, I expect it to be what? To be going down. Let's continue. Now, the next one here is we have 8 major currencies traded in the forex market. And if you look at the currencies present here, they are currencies whereby their economy are doing fine. And these currencies, all the big players we said they involved in trading the forex market, these are the currencies they trade most. The first is the dollar, second is the European euro, third is the Canadian dollar, Switzerland franc, New Zealand dollar, Australian dollar, British pounds, and Japanese yen. You see, all these currencies are the most traded currency in the forex market. You see these people, the Switzerland franc. A lot of big men, even politicians, they like to save in this currency. Why? You see, if we are to experience world war, God forbid, if we are to experience world war, this currency will not involve in war. And once a country is not involving in war, it will still make their currency to be strong. Whenever war intends to break out, or we are intend to experience what we call war, all this currency you are seeing, they will be decreasing in value. People will be looking to save money in commodities like gold, for example. They will be looking at something that will be there for a long time, regardless of if war happens. So all these currency you are seeing, they are the most traded in the forex market. And as we are seeing them like this, they are the 8 major currency. We can't trade them unless we see them in pairs. You can see now, we can now see them in pairs. And if I ask you, what is the most present currency among all the currency pairs? Which currency is present among all of them?
The US dollar.
Exactly. You can see the US dollar is present. That is, if it is not dollar, US dollar, it is not making sense. Dollar has to be present for us to be able to trade. Dollar signifies liquidity. Dollar attracts liquidity. Whenever there is dollar, this is Euro USD. You can see Euro against USD. Here, what is the base and which one is the quote? The Euro here is the base and the dollar here is the quote. That means if I tell you to buy this asset, I expect Euro to appreciate against dollar. I expect it to capitalize because it is stronger as at that moment. You can see now that this market is falling. If I tell you to sell, I now mean that this dollar is weak and this dollar is now stronger than euro. And if dollar is stronger than euro, it will make the market to be falling. Once euro regain its strength to be strong, we'll be seeing this market going up. Once dollar is strong, we'll be seeing this market going down. You can see. So the 8 major currencies traded are the presence of dollar. Dollar is what attracts a lot of big players, firms, to participate in trading the forex market. The minor currency, obviously, you can see the minor currency. It has the absence of dollar. But even though this pair have the absence of dollar, that doesn't still mean it is not tradable. If we go all the way to look at Euro GBP, which is Euro British pounds, you can see Euro British pounds. It is still tradable. It will still move, but it's just that sometimes some people don't really like to trade in absence of dollar. But there are some traders that still prefers a currency that does not have the US dollar. You can see this market is still tradable. It's still going in its direction. The euro here is the base. The British pounds is the quote. So that means that currently the British pounds is stronger, and that's why this market is bearish, is going down, is selling from here. whenever euro regain its strength, we will be seeing it going to the upward direction. So that's it. So we can pair all other pairs together, but the absence of US dollar, that's why they are classified as minor currency pair. Now, exotic. There's actually a TikTok a TikTok handle that makes this exotic thing, that makes me make fun of this exotic word. So what do we classify as exotic? Exotic is when we pair an underdeveloped nation to a developed nation. So that means that if I'm to pay this USD NGN, obviously we can't see NGN in the most traded currency because a lot of firms are not trading it, even we as an individual. So you expect me to leave Euro USD and I'll go and trade NGN, USD NGN. That means I don't want to make money. That means I don't even understand how the dynamics of Forex works. I can't trade these exotic pairs because even let's go on it, let's go and check it on our chart. You will see the chart itself will not look healthy. Why? Because there's no volume, there's no money there. So why do you expect me to trade it? Why do you expect me to trade something whereby there's no money? You can see our brother USD NGN. What is this? What is this? And what does this simply mean? The reason why you are not seeing familiar thing is because there is no volume. Nobody is participating to trade this particular asset. So that shows that since there is no volume here, why will I be trading USD NGN when there is no volume? Even the spread will be so large. In fact, how broker tends to charge spread is if people are not trading a particular asset, the spread will be very, very huge because there is no volume here. But in a market whereby there is volume, it will look healthy. You will know there is money there. And like Euro GBP, there is money. That's why we are seeing it like this. It's money that is making it to fall. When you start buying, it is money that is pushing it up. So that's exotic pairs. Now, for us to see another example of an exotic pair, if we are to check an asset again, okay, don't let us be biased. Let us check USD case, Kenya Chile. We don't want to be biased here. You can see, what the hell is this? What is this? There is no volume here. People are not trading it. So instead of me saying I want to go and trade US dollar against Kenya Chile, no. I want to trade the most volatile pairs. I want to trade pairs whereby a lot of people are looking to trade. I want to trade the most traded pairs in the forex market, which is by pairing them together, which is by pairing the most traded pairs together, pairing USD against this, pairing NZ. These are the most traded. These are countries whereby their economy are doing fine. So obviously it will reflect on their currencies. Nigeria, sorry to say, our economy is so bad, so I don't expect people to be trading or for the currency to be reflecting on the chart. Obviously, I don't expect it. So that's just it on currency pairings. You can see, this is the lot size table I was telling you about. This is the standard lot. With one standard lot, if market just move by a pip, you are making $10. If it move by just one pip, and what do we mean by pip? Pip is how market start going to the upside. So if before this market start going to the upside, if it move by just 10 pips and you use one standard lot size, that means you are making $100 already. If you are using mini lots, if market just move by one pip, you are just making 10. If it move by 10 pips, you are making $10. You can see this lot size will determine how we want to use it regardless of our account size. If I have big funds, I can stick to standard lots. If I have mini funds, lower funds, I can stick to micro lots or mini lots depending on how I intend to grow my account in the long run. Do you understand? Let's continue. Now, we have what we call trading order. This trading order is just like an order whereby if I want to make an instant execution, I want to buy a particular asset. Once I buy, I enter the market, I saw the market, I want to buy instantly. That's what we call market order. I'm buying instantly. That's what we call market order. And as I'm buying instantly, I have set my stop loss, I have set my take profit. This is my take profit, and this is my stop loss. I'm buying, I bought instantly. I expect this market to go all the way to my take profit. But what will happen if I intend to buy here and the market has not reached there? That's what we call pending order. You want to set what we call buy limit. You want to set what we call buy limit. That buy limit represents pending order. You want to set it in a way whereby, and as you are setting your buy limit, you are also setting your stop loss. And in fact, you might forget to set take profit, but that stop loss is important. Because this one, you want to set that buy limit because you don't want to be monitoring the market, but you have done your analysis that once market falls to this place, it should pick up your order. And once it picks up your order, it must not go below your stop loss, but it must go all the way to where you are what? Targeting. So these are what we call pending. If I also want to sell, it is what it is called sell limit. It is still pending. It shows that once market gets here, I must have been doing something, but I must have set it. My stop loss will be above. So once market gets here, it should pick up my order while I'm doing other things. Pick up my order, don't go near my stop loss, and come all the way down to my take profit, which is here. So pending order and market order. Market order is an order we execute instantly. Pending order is the kind of order whereby whether we are buying or selling, market has not reached our points of interest, but we want to set it down. So whenever market reached it, it should pick up our order and start buying the market for us. So that's pending order. Let's continue. You can see these are the types. Now we have what we call trading platforms. You see these trading platforms, these are the platforms whereby we use to trade. Especially this is the main one we'll be making use of. All these two, this one too is a trading platform. But the most important one we use is this MetaTrader. We call it MetaTrader 5, MT5. MetaTrader 5 is there on App Store. You see this MetaTrader, this broker, once we register on a broker, this broker will provide us a login to enter this MetaTrader 5. And whenever this broker provides us a login, we can log in two separate accounts. The first one can be a live account. This is where our refunds will be. The second one will be a demo. This is like a demonstration account that will be with a virtual money. The money inside the demo account is not real money. It will be virtual money. Where real money will be is this live account. So as we are learning, we expect us to practice on this demo first before we start practicing on this live. But this broker is responsible to giving us these login details to be able to trade on the MetaTrader 5 platform. So we will be having two separate accounts, the live account and the demo account. Now the next one here is this trading view. Trading view is where you can check all your analysis. If you are a trader, if you call yourself a trader, nobody can just tell you otherwise. You can decide to go all the way. I want to buy shares. I want to buy Apple shares. I don't just want to be using iPhone. I just want to also invest on the company. If you are buying Apple shares, you also want to go on their chart, analyze. Look, even if you want to analyze, you can see currently the Apple stocks is what? What is happening to the Apple market? What is
It is falling.
Thank you. No, I won't accept falling. I want you to be responding as a forex trader now.
It is bearish.
Thank you very much. It is bearish. You can see you are now being innovative about what is happening. You have been enlightening. It is bearish. The Apple stocks is bearish. Your iPhones that you used to connect into this life is currently bearish. So that means that even if I want to invest, or buy these Apple stocks and hold and invest and have a share in Apple. I don't want to buy now. There is an analysis that will make me wait for the market to reach here. This thing that is buying, that is falling here, experts, people who have knowledge on how markets operate, they will not be looking to buy here because it is still falling. They expect this market to fall at a discount price. I don't want to buy a premium price. A lot of gullible people, when they tell them to go and buy Apple stocks, they will buy here when it is buying, when it is going up to the upward. Professional traders will never buy here. They know market will still fall. They know people who start buying from here, they will be looking to take profits, and it will result to market to be falling. And if it is falling, this is the right place in a plain analysis. This is the right place to expect this market to fall to and buy and have a share in Apples. I don't just want to be changing my iPhone every year. If Apple are making money, I also want to be making money. As long as their stocks keep rising, my own pocket too needs to be rising. That's just it. This is the things we will be doing on TradingView. TradingView is there. It's like a tool that will make us analyze, see every asset, see every stocks, see every commodities, see every, even if it is Bitcoin. For a lot of people that are familiar with Bitcoin, we can analyze and check anything. Your company, a lot of people that, maybe some of us that does 9 to 5, if we have a popular company, or even if, for example, Access Bank, Access can say, okay, come and buy my stock, come and buy my stocks. If they tell me to come and buy their stocks, you can see, you can see. If you are conversant, you can see this is why it is good to do analysis. If you are conversant of what we did in the last class, I told you that this is where I'm expecting to buy. What is happening now? What is happening? What is the market currently doing? When market reach this place I mark, you can say I've done this thing down. I did it in the first section. I said that even if I want to buy Apple Access stock, this is where I want to access shares. This is where I'm interested. You can see market reached there, and what is happening? The market is now bullish. These are things having the Forex knowledge will give you. It will enlighten you to a lot of things. You don't just want to be buying stock, not knowing when to enter. In fact, as a stock buyer or as someone that wants to buy anything, you want to know where to buy and where to go out from. If I want to be going in and out of these access shares to make money, I will be looking at this place again as a sell opportunity. That means when this market reach here, I want to sell off. That's it now. These are things the market will open your eye to. Having the Forex knowledge, this is what it will open your eyes to. So that's it. The TradingView is a platform whereby we used to analyze. I analyze finish. I know where to buy my stocks. What I just need to do is to go to Bamboos or any investing apps, buy them because I've analyzed to where I want to buy it from, and make money. That's it. So whichever way we choose to make money is how we will make money in the Forex market. You can see this is the TradingView logo. This is the MT5 logo. Now, so we have types of analysis. The first one is technical analysis. Technical analysis has to do with what I just did now. It's technical analysis. I did some kind of analysis that will make me expect the market to buy here. Is what we call technical analysis. The next one is fundamental analysis. You see this fundamental analysis, it has to do with economic news or data. You see this currency we are trading, sometimes news might affect them, and there is a site platform here that makes us know if there is news. You can see today is January 8th. We want to be conversant. You can see the currencies here. Japanese yen, Australian dollar, Japanese yen, all of them. They have news today. But we want to be conversant of the one that is reddish. We know what red means. Red means danger. So that means the ones we are interested in are the reddish one. You can see today, as at 2:30 p.m. Nigerian time here, we had news on US dollar. It is reddish. That means it will have impact on any USD pair. It will have impact on any USD pair, whether it is positively or negatively. It will have impact. And as at that time, if I'm to go and check that particular time the market, the news happen, it will reflect also in the currency. It will reflect also in the currency. So anything that has to do with fundamental, looking at if there is economic news, you know, the CBNs of these currencies, just like we have CBN in Nigeria, CBN in Kenya, everywhere, the CBN of USD too, they might want to adjust or increase an interest rate or inflation rate. All these things affect currencies too. So all those things are what we call fundamental analysis. So we also have what we call sentimental analysis. This has to do with looking at majority of what people are doing in the market. Looking at Euro USD, I just want to look at what majority of people are doing. This is another type of analysis. This is another type of analysis. You can see Euro USD. I want to look at majority of what people are doing. What are people doing here? I can see the percentage of people buying is more than that percentage of people selling. I might decide to follow the percentage of people buying, but this is not a right way to trade. We don't make use of sentimental analysis as a forex trader for just to quickly make a decision. No. The only thing I can do it is that I have done my analysis on Euro USD. I want to sell or buy. I now went all the way to check what majority of people are also doing. If it also tallies to what I want to do, fine, it's good. That means I'm part of the what majority are doing. So that's what sentimental analysis has to do for us. Trade management analysis. So this has to do with the kind of analysis that has to do with us, how we set our take profit, how we set our stop loss and take profit. It has to do with us. So that has to do with us. And lastly, emotional or psychological analysis. This has to do with us too. You see, emotion, everybody has different way of how they want to see the market or how they want to approach the market. And this is what a lot of traders normally suffers from. They don't teach someone this one. You get to discover yourself with this. What do we call emotions? How do you react when you take a loss? If some people, they will take a loss, they just don't want to follow the same process they are doing. They just want to trade blindly. There are some people whereby it is greed. I make $100. What I did to make that $100, I will not follow it again. I just want to enter the market with the hope that I just want to make more. At the end of the day, you now go all the way to what? To lose the 100. So these are the mindsets of traders, how we handle losses. When we profit too, how we react. We don't just to be on top of the moon, open that, as I make profits now, I quickly want to go back to the market again to make. No, it doesn't work like that. You made a profit, you want to relax. Look at what you did to make that profit. Repeat the same process again. So you don't want greed to take over you. And open, you know the analysis you enter, you know the trade you enter is the wrong trade, but you are now opening the market to go to the upward direction. But meanwhile, it is a market that is bound to sell. Prayer doesn't move markets. Prayer doesn't move market. I've entered this market. I pray, God, Jehovah, let this market go up. No. What moves markets is liquidity, majority. If majority are buying and you are selling, you don't expect the market to go in your direction. No. So prayer doesn't move market. The only thing you can pray for is for you to choose right, enter right, and not make mistakes. That's the only thing you can pray for. So let's continue. Now, the last one, before we call it a day at the end of this, we'll try and wrap it up. Line charts, types of charts. You see, this chart is what makes us to analyze the market, what makes us to see the market differently. It is the one that will make us understand. Now, we this generation trader, we are very, very lucky. Before we see this kind of chart we are seeing, there was a chart we were using before. It is called line. You can see this is the kind of chart they use then. The transition from this, they make use of what we call the next one, bar charts. You can see bar chart looks like this. Bar chart looks like this. You can see all this type of chart, they don't have enough information for us in order for us to buy or sell until civilization keeps setting in until we have what we call candlestick. You see, this candlestick was originated in Japan. The Japanese, they have been trading with what we call